Hey everyone, and welcome. Today we are going to tackle the world of stocks. If you've ever felt a little lost when your friends or people online start talking about investing, you are in the right place. We are going to break it all down. Super simple. So you're scrolling through your feed, right? And you see posts like just invested in Tesla or buying the dip, and you're kind of left wondering, what does that actually mean? Like, what are people really buying when they buy a stock? Let's get right into it. Okay, first things first, to really get what a stock is, we're going to use a super simple and, yeah, pretty delicious analogy. At its heart, a stock is just a share in the ownership of a company. So when you buy a stock, you're not just getting some digital receipt. No, you are buying an actual tiny little piece of that business. It's a pretty cool concept when you stop and think about it. Here's the best way to picture it. Imagine a huge company is a giant cake. That cake is cut into thousands, maybe even millions of tiny slices. Each one of those slices, that's a share of stock. And when you buy one, you get to own your very own piece of that company cake. But why? Why would a company even want to sell off little pieces of itself? To answer that, let's follow the story of a dream sneaker store called Fresh Kicks. All right, so meet Maya. She's got this amazing idea for a business, a super cool exclusive sneaker store she wants to call Fresh Kicks. Now, to get this dream off the ground, for the rent, all the cool sneakers, the marketing, everything, she's done the math. She needs $100,000. Now, she could go to a bank for a loan, sure, but that means a lot of debt. So Maya gets creative. She decides to divide her new company, Fresh Kicks, into 10 equal shares and sell them to investors who believe in her idea. And this is where Jordan comes in. He's a huge sneakerhead, he totally gets Maya's vision, and he wants to be a part of it. So he buys one of those 10 shares for $10,000. Just like that, he now owns 10% of the entire company. And guess what? The business explodes. In just 5 years, Fresh Kicks goes from one little shop to a whole chain of successful stores. It's an absolute hit. And all that success makes a big difference. The business, which started out with a value of $100,000, is now worth a whopping $300,000. So, what does this mean for our guy, Jordan? Well, his 10% stake that he originally bought for $10,000, it's now worth $30,000. If he decides to sell his share now, he pockets a $20,000 profit. Not bad at all. But hold on, investing isn't always a home run. It's not always a success story. We have to ask the big question, what if things didn't go so well for Fresh Kicks? Let's just imagine that instead of booming, the store had some tough competition, and its value actually dropped to $80,000. Well, in that scenario, Jordan's 10% share is now only worth $8,000. If he sells, he takes a $2,000 loss, and that, my friends, is the risk. Okay, so we see how it works for a small business, but where in the world are people buying and selling shares of gigantic companies like Tesla or Apple? Let's take a look at the actual marketplace. All of this trading happens on stock exchanges. You can think of them as these huge, global marketplaces for company shares. You've probably heard of the big ones, right? The New York Stock Exchange or the NASDAQ. But here's the crazy part. You don't have to be on Wall Street anymore. Today, you can access all of this right from an app on your phone. All right, let's peel back another layer. It turns out not all stocks are the same. It helps to think of them as coming in two main flavors, or even better, like having two different types of tickets to the same awesome concert. Okay, let's break this down. First, you have common stock. Think of this as your regular ticket. It gets you voting rights in the company, so you have a say, and it has the highest potential for growth, which is exciting. But it's also riskier. Dividends, which are like profit-sharing payments, aren't guaranteed, and if the company goes out of business, you're the last to get paid. Then you've got preferred stock. This is your VIP ticket. You usually give up your voting rights, but you get more stability in return. Dividends are much more reliable, and you get paid first. Plus, if the company fails, you get your money back before the common stockholders. So less risk, but usually less potential for that massive growth. So with all this talk about risk and losing money, you might be thinking, why even bother? Why not just stick my money in a safe old savings account? Well, it really all comes down to the potential for reward. And here's the why in a picture. A typical savings account might earn you, 1 or 2% a year? But historically, over the long term, the stock market has returned an average of 7 to 10% a year. Over time, that huge difference starts to compound, which just means your earnings start making their own earnings. That massive gap in growth potential is the number one reason people are willing to take on the risks of investing. So, after all this, what's the big takeaway? Well, while there are no guarantees in investing, the most famous piece of advice is probably the best. Don't put all your eggs in one basket. This is what investors mean when they talk about diversification. In the end, buying a stock isn't just a number on a screen. It's you investing in a company's vision for the future. So the real question becomes, what future do you want to help build?